Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Century Communities Inc. quarterly report. Century Communities, Inc. offers a wide range of businesses and services including home design and development, construction of single-family attached and detached homes, marketing and sale of homes under the Century Communities, and Century Complete Brands entitlement and land development, mortgage services for homebuyers, title services for homebuyers, insurance services for homebuyers. The company sells its homes through various channels, including sales representatives, retail studios, internet, and independent real estate brokers in 18 states across the United States. Century Communities Inc.'s stock price drop. A year of challenges in the past year. Century Communities Inc. CCS has experienced a significant decline in its stock price, plummeting by 34.27% with a one-year total shareholder return of -40.6%. The primary cause of this drop is the impact of challenging market conditions on the homebuilders' performance and outlook. High mortgage rates and reduced affordability have dampened demand for new homes, forcing Century Communities to increase sales incentives and accept lower average selling prices. This has put downward pressure on gross margins, revenues, and earnings, further weighing on future quarters. Economic uncertainty, interest rate volatility, and decline in consumer confidence have also contributed to a slower selling season. Despite reporting solid financial results in recent quarters, beating analyst expectations for earnings and revenue, the broader market conditions and their projected impact on future performance have been cited as reasons for a less celebratory stock performance over the longer term. The primary drivers of revenue growth or decline are multifaceted and influenced by various macroeconomic factors. On one hand, revenue growth can be attributed to increases in land sales and other revenues, net gains on sale of mortgage loans, fees earned from originating mortgage loans, and changes in fair value for mortgage loans held for sale. On the other hand, revenue decline is primarily driven by a decrease in home sales revenues, lower average sales price per home, and a decline in backlog units across various segments. Additionally, inventory impairment and abandonment of lot option contracts have also contributed to revenue decline. The macro drivers of these trends include demand fluctuations in the housing market, interest rates and Federal Reserve policy changes, inflation, consumer confidence and spending, employment levels, availability of financing for homebuyers, and general economic conditions. Net income and profit margins experienced a significant decline in the 9 months ended September 30, 2025. Net income decreased by $119.4 million compared to the same period in 2024, while net income margin dropped from 7.4% to 3.8%. The homebuilding gross margin percentage also declined from 21.7% to 17.9%, and adjusted gross margin percentage, excluding certain costs, fell from 23.6% to 20.1%. The primary reasons for this decline include a decrease in inventory sales, increase in abandonment of lot option contracts, inventory impairment, slower absorption rates, higher incentives, decreased net new contracts, reduced demand due to economic uncertainty, and adverse general economic conditions. These factors collectively contributed to the decline in profit margins and net income. The company's financial performance indicates a decline in its ability to generate positive operating cash flow. According to the provided summary, the net cash used in operating activities is a significant negative figure of $57.7 million. This suggests that the company is currently struggling to produce sufficient cash from its core operations, which may pose challenges for future growth and sustainability. The company's financial health has undergone notable changes in terms of its debt level and interest expenses. A review of the data reveals a significant increase in total debt, from $1,911,616 to $2,115,953, indicating a substantial rise in liabilities. Furthermore, homebuilding debt also increased by 18% over the same period. However, despite this increase in debt, the company's interest expenses have shown a notable decrease. Net interest expense has dropped from $2,693 in 2024 to $445 for the 9 months ended September 30, 2025, indicating a substantial reduction in financial burden. This suggests that the company may be benefiting from lower interest rates or more efficient debt management strategies. Management's outlook on company strategy. According to management, the company is focused on serving the affordable homebuilding market through its Century Communities brand. However, they are cautious about the outlook due to various risks and uncertainties, including economic changes, labor shortages, and a downturn in the industry. To adapt to changing market conditions, management plans to adjust their operating strategy while leveraging favorable demographics that support the need for new affordable housing. They will also continue to provide incentive offerings across communities to boost sales. Management is confident in their ability to fund current liquidity needs for at least 12 months with available cash and credit lines. However, they are concerned about a sustained downturn in the homebuilding market due to economic conditions, rising interest rates, and potential liquidity issues. The company has made significant acquisitions and divestitures in recent years. Key acquisitions include Landmark Homes of Tennessee, Inc., acquired for $33.4 million in January 2024, and Anglia Homes LP, acquired for $127 million in July 2024. In terms of divestitures, the company sold mortgage servicing rights with an unpaid principal balance of approximately $3 billion in the second quarter of 2025. Additionally, it sold a majority of its mortgage loans held for investment at fair value and amortized cost during the 3 months ended September 30, 2025. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In the past year, it declared and paid cash dividends totaling $26,312 in the 9 months ended September 30, 2025. Additionally, the company repurchased 1.9 million shares for $123.6 million during the same period. These actions demonstrate a commitment to rewarding shareholders through both income and capital appreciation. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. Inventory levels have increased by $129,909 from December 31, 2024 to September 30, 2025, raising concerns about potential inventory buildup. Additionally, there are shortages of labor, land, and raw materials used in housing construction, which could lead to supply chain disruptions. The homebuilding industry is also facing potential cost increases due to new tariffs on imported products such as cabinets, lumber, and wood products. Raw material and building supply shortages, along with price fluctuations, may further delay or increase the cost of home construction. Inventory impairment charges have been recorded in both 2024 and 2025, totaling $11 million for the 9 months ended September 30, 2025. These charges indicate that some inventory may be impaired due to market conditions, adding to concerns about inventory buildup and supply chain disruption. That concludes the financial summary for Century Communities Inc. Feel free to comment below, and I will be happy to answer them when possible.